What's up, guys? Thanks for tuning in. We'll start this price action video with a short scalp. As you can see from this 5-minute chart, after the market surged upwards by more than 20 points, it broke through a structural high and tested the top of a 4-hour order block, represented, as you can see, by the blue dotted horizontal line. The market then entered into a consolidation phase before hitting another high point via this stop hunt expedition. This price action is typical, I think, of a demand side market where buyers are in control and willing to accumulate and continue buying at higher prices. Now, with the overall trend being bullish, it would make sense to consider any dip as a buying opportunity. That said, though, I would argue against that assumption because, for one, if a security price advances, we should see an increase in trading volume and spreads, and that is not the case here, clearly, as you can see from the chart. Secondly, the liquidity grab action up here, which marks a primary intraday structural high, followed by this pullback that leads to an area of high confluence between this double break in market structure and subsequent formation of these head and shoulders, a pattern which, as you know, signals a possible trend reversal from a bullish to a bearish cycle. Now, this area of confluence offers, in my view, some good insights into this trading range's structure, as well as the possible directional bias of the current price movement. These factors, combined with the price entering into a 5-minute order block, supported, in my view, the case that the market was gravitating more and more towards the sell side. That said, though, at this particular price point, with the recent formation of these higher lows, there is an argument to be made that the price will move upwards. The point with that approach is that in addition to the large supply spreads being clearly present, this price action is misleading in terms of the market's immediate trend direction. The question would be why? Well, I think because in order to correct this imbalance zone, which, if you note, is the only available target in this range, market makers clearly misled the demand side about the future trend of the price, so they could buy more shares at a lower cost as part of their pre-planned markdown campaign. And as you can see from the chart, after I was filled, the market moved past the order block and into the imbalance zone I just mentioned, a move that would have been a more precise entry point before the market started its nosedive towards my first target that correlates to the range's support level. As I've often implied in my videos, guys, when it comes to price action trading, you have to be like trend detectives, meaning you have to sniff out clues and piece together the puzzle. That's where the real profits come from. The second target aimed obviously the correction of this imbalance zone down here.
Target filled.
Alright, with this straight out of the way, let's move on now to the next part of this video where I'll briefly go over an order block indicator that's totally free to use for everyone and one that honestly I have found helpful if utilized properly. As you know, order block indicators are used to identify block trades in a security or market. Obviously, they are an important tool in trading, given that they can provide a significant advantage to traders who know how to use them effectively. Now, order blocks obviously are simply defined as areas of support or resistance where there is a concentration of orders. These orders can be from a variety of market participants, including market makers, institutional traders, and retail investors. Because order blocks represent areas where there is significant interest in a security, they can provide important clues about future price movement. For example, and this obviously applies mostly to the noobs out there, but if a security is approaching an order block from below, it may be indicative of rising demand and potential for further upside. Conversely, if a stock is approaching an order block from above, it may be indicative of increasing supply and potential for further downside. Again, by identifying order blocks, traders can get a sense of which direction prices are likely to move in the future. I'd like to point out that while no technical indicator is perfect, this order block indicator is the best one I have found on TradingView so far. It's a two-in-one indicator, meaning that not only identifies block trades, but also breakouts in market structure. I think that using an order block indicator like this one can help us make more informed decisions about when to enter and exit trades. And guys, it's not like I'm getting paid or being sponsored to advertise this thing. It's just that I have found it to be a good tool in my trading, and I'm simply sharing it with you today. Alright, so let me show you how to set this thing up and what settings to change. It's pretty basic, really. The first thing you'll want to do after going on TradingView is click on Indicators. After that, type order block by EMRE, E-M-R-E, into the search area under Indicators, Metrics and Strategies profile. Then click on the Market Structure Break and Order Block indicator. The next step would be to go into Settings and then Inputs to uncheck this box next to the Show Zigzag Input. You will also want to keep the time frame option clicked on the chart setting. This is because some time frames you may select will not be displayed. Obviously, this is not ideal, but by keeping this input set this way, you can still get a good overview, I think, of the overall price action. Also, under display settings, there are a number of abbreviations, and I have made this short list of what they stand for. Finally, under Style, uncheck the box next to Labels and click OK. This option allows for a better view of the indicator and keeps your chart looking clean. And as you can see, here we have a bearish order block cleanly displayed on the chart, followed by a bullish order block. These are also followed by these bearish and bullish breaks in market structure. And that's basically it. You are now ready to start using this effective indicator, I should say, to help you trade the markets. Alright guys, so that should do it for today. Again, thanks for watching, and as always, if you liked the video, please make sure to like and subscribe to the channel. I would really appreciate it. Thanks again, and until next time.